So the global markets have been in decline for a few weeks now, and since it's been quite some time since we've seen significant declines like this, I thought it would be an appropriate time to make a video talking about some of the beginner mistakes that I see people making when they've been investing throughout this, and if this continues into a recession. And joining me to talk about this is Brandon from the Aussie Wealth Creation YouTube channel, as well as the other co-host, the second best co-host of the rough. Young Investors podcast.
Jeez, way to treat a guest.
Yeah.
How rude.
Okay, fine.
Leave a dislike on this. No. I've stitched him up now, boys. No, definitely leave a like.
Leave a like.
Leave a like if you think that Hamish is the best host of the Young Investors podcast, and leave a comment if you think that I'm the best host of the Young Investors.
That's beautiful.
But do not touch that dislike button.
That's beautiful.
We will get angry.
Yeah, don't touch it. All right.
So we're talking about 5 different ways that, or 5 mistakes that people potentially make in a recession.
Yeah, definitely. And let's just jump straight into the first one. The first one is selling stocks with the belief that they will continue to fall. So this one's just a classic short-term psychology-driven mistake.
It's a mindset thing.
It really is, yeah. And I mean, the media just feeds right into the fear that people have when these kind of events are happening. As soon as this thing sort of started, it was like, 20% of the news was talking about this event.
There's a good chart saying that in times where the market goes up, the financial headlines are positive, and then in times when the markets are going down, the financial headlines are increasingly negative.
Yeah.
So you're going to hear in bad, like it's just a given, in bad economic times, you're going to hear bad financial headlines, and like people just continue to predict more doom and gloom.
Yeah.
But yeah, selling stocks with the belief that they'll continue to fall. It's totally a mindset thing, because of course you can't predict when the bottom's going to be, right?
Yeah.
It's just something that you can't predict. So selling these stocks because you think, what if the market went down 10% and you think it's got 30% to fall, which turns out has happened in this case. But say it went down 10%, you sold all your stocks because you thought it was going further, and then it just rebounded 10%. We've seen plenty of times before.
Yeah, I mean, in late 2018, that's almost exactly what happened. It dropped 17% very quickly in the space of a couple of weeks. And right at the bottom, people were screaming, "I'm selling everything. This is the start of a global recession."
Yeah.
And it wasn't.
Yeah.
So that's a circumstance where, I mean, it's really going to come down to luck if you're using that method. If you're trying to time the market, you might be right. I can't say that you will be wrong every time, but in many circumstances, you will be wrong. And when panic is at its maximum, and when you're going to be most likely to sell using this method is often near the bottom.
Yeah, exactly right.
Yeah.
And you got to follow that unwritten rule of investing, right? If you make an investment, then the stock's going to go down.
Yeah.
If you don't make the investment, the stock's going to go up.
Yeah, it always happens.
But yeah, I mean, selling stocks with the belief that they'll continue to fall, it's just not, you just don't want to be thinking like that, because in reality, you've got no idea how far it's going to fall. The only thing you can do if you're buying individual stocks is make sure that they're high quality, make sure they're being offered to you at margin of safety prices, and if they are, then you buy them.
Yeah.
Or if you're a passive investor and you just track the market, then just use, just buy slowly. If the market goes down a bit, maybe put a bit of money in. And then if it goes down further, then you can put more money in. You just don't want to be trapped, I guess, putting everything you've got in at the one time, or, taking it out because it could go
definitely
fall further.
Yeah. And number 2 for today, the second mistake that beginners make when they're investing is pretty much the opposite of the first one, which is buying stocks simply because they have fallen.
Yeah, just because they've gone down.
Yeah, I mean, you see it everywhere. As soon as stocks fall 10%, they fall 20%. Everyone is saying, buy the dip, buy and hold. Stocks are on sale.
They're on sale. Yeah, discount. Discount is the word. It's
that term really, really bothers me, because stocks can fall for a variety of reasons.
Yeah.
There can be many different reasons that a stock falls, and one of them is that a stock might have been fairly priced and it's just been dragged down with the market, and now it's 20% undervalued. That could be one of the circumstances, and that's probably the only circumstance in which you would then want to go and invest. But why was the market necessarily right before when pricing that stock and now it's incorrect? Why couldn't it have been 20% overvalued and now it's fairly valued? Or why couldn't it have been 50% overvalued and
now it's 30%?
Now it's 30%. So,
and that's exactly the thing that we were talking about not too long ago. We were just talking on Facebook and saying, man, the market's gone down 20% at that time. That's what we're looking at. And we were running our valuation methods on the big US techie kind of companies. And we're going, this is just crazy. The market itself has fallen 20%. These stocks have gone down with it. And they're still overvalued. These companies are still overvalued.
Yeah.
You could even look, if you don't want to pick individual stocks, you could look at something like a Schiller PE for just the S&P 500, say. And the Schiller PE is now falling, but I think it's gone from 30 to 24, and the average is 16. So it's like, man, even now, it's still like after 20%, 30% declines, it's still looking like it's still bit pricey. So yeah, I definitely don't think that people should buy stocks simply because they have fallen. That's totally the absolutely necessary thing if you're buying an individual stock is you have to have at least a decent understanding of what you think it's worth. Because otherwise, any investment you make is pure speculation. So you have to have an understanding of what that business is roughly worth so that you can then take that share price into context and you can say for yourself, well, actually, even though the market's gone down 20%, this particular company's fallen 10%, but it's still 30% overvalued. Or you might find that the market, Mr. Market, has pushed the price of your company down 50%, and now you're looking at your valuation that you've calculated yourself, and you go, oh, actually, it's now 30% undervalued.
Yeah. I mean, the one thing I always wonder is why should you care what the stock price was a week ago? Why should you care what it was yesterday compared to what it is today? Because you should think of the stock price as the market offering you a price.
Yeah.
This stock for $50 per share. It really does not matter what that stock was offered for a week ago. What matters is comparing that to what you're going to get out of it.
Yeah.
So how far a business has fallen is really not an indication of anything except that the market has changed its opinion about what that business is worth. But the market's often wrong, as we've seen. It's often irrational, and there's certainly been a lot of irrational selling that has caused many stocks to fall over the past few weeks. All right, should we jump into number 3?
Yeah, let's do it.
Yeah, so number 3 is investing in companies before doing thorough research. And this sort of comes about from the classic FOMO phrase, which is fear of missing out. Investing in companies that you haven't thoroughly researched. So again, this is usually a mistake made in combination with the one previously, which is that you're buying stocks just because they've fallen. They kind of go hand in hand. You see people who are buying big brand name companies because they've fallen 20 or 25%. They think, okay, this big brand name company must be great because it's got a huge brand attached to it, and it's 25% on sale because it's fallen 25%. But that is just because it has a big brand name attached to it really doesn't.
No, it doesn't mean it's a great company.
It's not good enough.
You do have it's not good enough to buy something because of the brand or something. You could have a great brand but a very poorly managed company.
Definitely.
I mean, you might even have a great product. Maybe a product that is just awesome, but then it's still a poorly managed company.
Yeah.
So you're right. It's obviously going to happen that you see these big declines, sudden declines, and then bang, you feel it in your stomach. You get this fear of missing out. Like I've got to get in now. Everyone around me is telling me this is the time to invest. This is the opportunity that we've been waiting for. But it's very dangerous. It's just very risky if you just jump in before you've really done the research as to, how the company operates and what the competitive advantage is and what the management team, how they run the business and that sort of stuff. So yeah, I just think it's very risky if you start jumping into companies because of fear of missing out before you've actually done your research in it. And that's what I kind of think.
Yeah. And if you haven't researched the company, if you buy that stock and it falls, you're going to not know what to do. You won't know if, this is actually not a great business that I should sell my stocks at a loss, or should you buy more? The only way you can know or feel confident in your decisions after you have purchased the stock, not just before, but after as well, is if you deeply understand the business. If first you have to understand the business, understand the industry in which it operates, you have to have identified a competitive advantage, you need to have looked at management, and you need to have a good estimation of how much cash you can get out of that business in the future.
Fourth beginner's mistake. This is classic. Trying to time the market with index funds or ETFs. So you want to be a passive investor. So you want to buy the whole market and track it over a long period of time, but you want to try and get your timing absolutely right.
Yeah, exactly.
I think that there's a big problem here in just the whole, again, it's the whole mindset behind this phrase. Trying to time the market with an index fund. You got to remember, what are you trying to do? How do you get success out of investing in an index fund or an ETF or whatever? You get success from investing consistently in that same investment, tracking the market over an extended period of time, like multiple decades. So yes, obviously everyone wants to try and buy their shares at the low point. I mean, obviously, but you got to, again, recognize that you can't, there's no way of knowing when that's going to be. So instead of trying to, think about the next year of returns and, oh man, imagine if I could just buy, in what was it, March 2009 or something,
right.
with an ETF, and then the next year I'd make this massive return. That'd be awesome. You got to think about, well, hang on, no, the market's down now. I'm a passive investor, so if I'm a net buyer of stocks for the next 40 years, then any market decline should be probably seen as an opportunity if you're following that approach. Don't worry about timing the market, but just get yourself started on that dollar cost averaging strategy or something like that.
Yeah, and I mean, as you said, if you're buying an index fund, you're trying to capture the average by definition.
Yeah.
So, I mean, the best way, if you excluded if you excluded all investing costs, and we were just in a vacuum, the best thing you could do to invest in an index fund would be to invest every single day, because then that way you capture the price every single day, and you're going to be very, very close to the actual average of that, say, the S&P 500 or the ASX 300. Obviously, in reality, that's not going to be the case because you have to pay brokerage, but you want to set up your plan in a way where you can invest frequently but still minimize your brokerage costs, maybe keeping them to below 1% so that it's not going to be a significant impact to your portfolio. And if you were to just dump a particular amount into an index fund all at once, you are very much at the mercy of the price on that day, which is completely random, and maybe it could be above what the index fund average is, but maybe it could be below. In many circumstances, it could be below, many it could be above. So if you want to do what the aim of an index fund is, which is to capture as much of the average as possible, then you want to be doing what's called dollar cost averaging, coming back consistently rather than trying to find the right time to get in.
It all in.
There is no right time.
No.
You won't find it.
Good luck. Like, if you hit it, then it's pure luck.
Yeah.
I mean, Warren Buffett, the world's best investor, he's the world's best investor. And he just came out with an interview the other day saying that, I don't think I have any idea, like, when the bottom of a market is. I've got no clue whatsoever. So I kind of just sit back and go with the approach, well, if Warren Buffett doesn't know, then I'm not going to try and kid myself and say that I know.
Definitely.
Yeah. Like, even if I had a guess, I'm like, I reckon we might be near the bottom of this. I got to then step back and go, I got no clue. Like, what am I saying? I've got no clue. So I think, definitely you don't want to try and time the market with index funds. You just want to have that mindset of, okay, I'm going to invest for a long time, dollar cost average, and then slowly work your way into the market over time.
Definitely. And the last one that we have for today, the last mistake that people make when they're investing in a recession is never investing because they think that it will go lower from here. So,
man, this kills me.
Yeah, so we spoke about people who sort of sell and try and time the market that way, and also buying and trying to time the market. But how about people who just never invest because of fear out of losing money? And the problem is that the best time to invest is often when markets are falling, but no one feels comfortable doing that.
Don't.
And people sort of think, I'll just wait until I feel comfortable investing. And often that time never comes, or if it does come, it's way too late. It's when the markets have been going up at 15% per year, or pretty much a straight line for the past few years. But
exactly it's just like the mentality of, grab the stick. Like if you see that opportunity, you have to take it at the end of the day. I think, like, regardless of all what we've been talking about, probably the biggest mistake is not, I think just in general, one of the biggest financial mistakes, full stop, is not investing, especially if you're someone that's young. If you've got 20, 30, 40 years before you're going to retire, then it is a really bad, like, it's horrible for you to not invest. I think I worked out once that if you're like 20, you retire at 65, if you invest $1, and you just get the average market return of, say, 7%. And I think by the time you're 65, that dollar has turned into $24.
Wow.
And that's like $1. Obviously, you just scale that up for however much you've got to invest. And, like, put that in perspective. If you've got money that you could potentially tuck away for 40 years, right? And, and you don't need that money in the next 40 years, then just figure out how much you can put aside, get out the calculator, and, times that amount by 24, and then see how much that money, that's the time value of money, right? It's what your money is going to be worth if you invest it now. So, and that'll give you a massive slap in the face, massive wake up call, right? If you see that, I've got 10 grand, and if I leave it just at the average market return, it could be 240,000 by the time I'm 65, then hopefully that's the jolt to the system that goes, actually, no. Even though I'm seeing the market crash and there's doom and gloom on the horizon and everyone's saying don't invest, if I do take a stab and go for the long run, then the numbers don't lie. I mean, we don't know what's going to happen into the future. That's the caveat always. But I mean, we've seen hundreds of years of stock market performance now, and it all evens out to about 7% per year. So
yeah, and I think that is as good a time as ever to wrap it up. Thanks, Brandon, for coming onto the channel.
That's
and
all right.
If you want to check out the other video that we did together, as well as the Young Investors podcast, we've got the Young Investors podcast on its own channel, and then of course the other video will be on Brandon's channel, which is Aussie Wealth Creation.
It is.
But let me know what your thoughts are down in the comment section below. Leave a like if you enjoyed it, and of course hit subscribe if you're not subscribed already.
Just do it.
God.
Yeah.
Are you?
What are you doing? How many of your views come from people that aren't subscribed? Do you know?
Maybe 50%.
50%.
Yeah.
I'm like 68%.
Right,
so
okay.
most people that watch my videos aren't subscribed.
Right. Okay.
So I must give valuable information, but also kind of tick them off at the same time. It's like, oh, that was a good video, but I don't want to stick around.
Yeah. Thanks everyone for listening, watching, listening. We're just
listening. Yeah, we just did a podcast.
Podcast mode. Yeah. Thanks everyone for watching, and I hope you have a great day.
See you later.